Good morning, Brenden Rendo with the Homes in Orlando team. Joined again here with Joseph Dionne of Appli Home Loans. Happy Thursday.
What is up? Excited to be here. We got some good news today, I think, or some mixed news. We got a whole bunch of random news.
Yeah, we got some good. We got a little bit of not so good, but been a while since we actually been able to come out and say, hey, this is good news for the consumers.
For the consumer.
Yes. And that good news is FHA announced yesterday that they are going to lower the mortgage insurance premium.
Yep. So that's the monthly amount that's that mortgage insurance. And it's been set at 0.85 for, I don't know, the last 5 years, 6 years. I don't know. It could have been long. I don't remember. But they're dropping it down to 0.55%. So that's a 30 BIP reduction on the MIP. And that's actually that's a decent number for consumers. There's actually a little bit of savings, some gusto to that savings.
Yeah. Let's look at it because we actually ran a couple little numbers to show people what the savings is going to be. Why don't you go ahead and go through it because this is your specialty.
Oh yeah. So I mean, I kind of use some round numbers just so we get some different ideas. So I said $250,000 buyer with 3.5% down. So that's just your standard, hey, your minimum FHA loan, but we're going to say $250,000 is the purchase price. And currently the monthly MI, that 0.85 is right at about $169.98. The new would be $109.98. This is actually perfect, just a super round $60. Straightforward. What that means is you either for the same home, you save $60 just because of this change. Or if you wanted to keep that same payment as before, you get about $8,000 in buying power. Then to give that little bit difference is, FHA, let's say $400,000 purchase price. Now the change is almost, we're talking 95, 98, much bigger change. Or monthly savings on that. And that's actually a little bit more buying power. So 12,500 in additional buying power. I think you think about that on a $400,000 home, which is kind of 250 in our market is on the lower side of what kind of buyers are doing, right? And then 400 is kind of the high of the median, the middle high side of the median, right?
Correct. Yeah.
We're right there, kind of it's there, but more buyers are in that 400,000, I think right now.
Yeah.
And $100 is $100. I think all of us would like to save $100 a month. I mean, that's almost a tank of gas for my truck. So I'm happy with that. If I could get a free tank, we're doing nothing else than just being an awesome person and being ready to go when that change goes into play.
I mean, that's $1,200 a year.
Yeah.
That's a nice savings.
So, overall. And that change doesn't go into effect until March 20th. So we're about a month ahead. They've got to do a little bit of that PR and give the updates and the release. We got to make sure HUD gets to have their official announcement and press conference, and the president, vice president gets to have their little hoo-ha. We got to make sure those things happen before it can go into effect. And there's some administrative pieces, obviously, as well. You can't just change the number of one system and it changed for everything. So it
really made sense because when you looked at the funding of the FHA MIP, it was the way they calculated it was extremely overfunded.
Yeah, very overfunded.
Which, honestly, I understand everyone's caution, especially going back to the recession of the 2007, 2008 when they it cost them a lot of money. So better safe than sorry overall. Definitely better safe than sorry overall. And then the other news, it's nice, but it's not making the effect that I think that they wanted it to.
Just before, FHA stole all the thunder here because VA made an announcement just beforehand that they're reducing their funding fee. This is awesome. So the funding fee for VA is upfront. It's kind of hey, you don't have monthly mortgage insurance with VA. We have this funding fee and it's a little bit higher. And it was 2.3 and now it's going to be 2.15. So 0.15 reduction. And then on subsequent use, it was 3.6. Now it's going to be 3.3, a little bit bigger. And I just wanted to give you guys just a super simple, hey, X's and O's, roundabout numbers. I didn't even look at what it was. I just kind of went into a prior file and said, hey, what's it look like? You're talking that drop is about $600 on that funding fee. But realize how many veterans pay their funding fee up front?
Zero.
Like nobody does, because VA allows you to put it into the loan and increase the loan amount to cover that funding fee. Very rarely do we see veterans pay that up front. And so what happens is it mostly gets paid and built into the loan. So what's that impact? Well, I had to go to 400,000 just to try to give a little bit of an impact. So you can see that, like you see right there on this scenario, it was kind of like, all right, boom, you're saving less than $4 a month. Like,
that's 1 gallon of gas for your truck, Joe. That's it.
I mean, that's 1 gallon. So over the course of the year, you're saving about $40, or what is that? $48. It's still a savings.
Yeah.
Over
what, quarter of a tank.
So there is, I mean, it is a dollar for dollar savings. So I don't want to discredit it. It is a savings. It is a benefit to veterans, because it was, again, they saw that it was overfunded. They could pull back a little bit. They didn't feel that they had as much room to pull back as others. And one thing that I still sit there and think, VA is still it's still 100% financing. So no down payment necessarily required. And it has no monthly mortgage insurance. So even though FHA had a bigger adjustment, if you're eligible for FHA and VA is still going to be the better loan option for you.
Oh yeah.
Because it doesn't have the mortgage insurance, the monthly mortgage insurance.
Yep. So, completely all day long.
Yeah.
All day long.
So
that was our good news for the consumers. But unfortunately, we had to come back and hit them with a little bit of not so good news.
Right. Sometimes I think markets adjust because they know this news is going to hit.
You wonder sometimes. And it just, all right, we're going to save $100 a month, but then interest rates have slowly been creeping up over the past week.
Yep.
And you can see, Valentine's Day, we're at 6.62. And as of yesterday, the average nationally was 6.88.
Yeah.
So that little bit of savings we had going to get eaten up by the little bit higher interest rates.
Yeah. And it's going to be interesting to see, because if we see this trend continue, when you see the movement that we saw in these markets and the bond market and so forth, like sometimes when you see these big jumps, these investors don't they're forced to increase rate, but they kind of hold back more than where they probably should sometimes, because they're like, crap, we're already slowing down. If we jump at 0.5% overnight or in a week or two, we're going to be toast. So then they sit there and say, let's tighten our margins even more so that we can slow how long. So I think if we see this and we don't see these markets kind of adjust back a little bit, pull back a little bit, I think we're going to continue to see these rates. Even if we stay flat, we're going to see these rates creep up over the next month.
Yeah, I think we're going to stay in this area probably through the summer. And the reason why I say that, main reason is the Fed, I think they're as long as that core inflation number stays where it's sitting, they're forced to continue to increase interest rates.
Yeah.
They have to. What were we sitting at? We're sitting 6.882, so their goals too, and they're far from it, which means that they're going to have to continue to continue that rate increase. And I think, more of them have come out to another 0.5 point increase at the next meeting, as opposed to the slower quarter point. Interest rate increase. And I think that's going to continue to force the bond market yields to stay a little bit higher until we can get to that level where they can actually say, okay, yeah, it's really, the economy's really slowed down. You're looking at continued wage increases. Walmart came out. They're jumping people from 17 to 1750, which doesn't seem like a lot, but when you look at the number of employees that Walmart has, that's a huge number. Yeah. And then Home Depot also came out and announced an increase in wages.
Yeah.
So the wage pressure is continuing to increase, which unfortunately is going to continue to, force that inflation number up a little bit. And until we hit that, we're just, it's going to continue to do it. And I think one thing we're going to see later from the numbers that's really important is how rate sensitive buyers are.
Yeah.
They are extremely rate sensitive. And I think we're going to see that when we get into the numbers here in just a moment. So it's a fine balancing game right now, going into the spring. When we get in there and we start looking at our numbers, let me hop back up to the top. And this is something we had mentioned, is that mid-January, we saw those interest rates drop. We got down, low sixes, around the sixes. And what did we do? We jumped to about 400. We had 400 closings last week. Yeah. Where in January, we were sitting at that 200 per week level. And when you looked at the number nationally for January, it was the lowest number of sales, home sales in like 20 years. Yeah. And they were projecting maybe 4 million, it's not a small number, but 4 million total sales nationally for 2023, which is a low number. We're staying consistent. We jump up and down on the median price a little bit, but we're sitting right in that $400,000 mark, plus or minus a little bit. But here's the thing again, inventory's dropping. It's just been a consistent drop in the inventory. And then overall prices, our original list to final list, we're consistent right in that 92% mark and have been for the past month, and 96% roughly for the final list to sales price. And again, we're sitting consistent. And then when you look at it on a graph, you can see how, here's the month of January, 200, 250, 250, 225. We jumped at the end of the month, which we always do. And then we pulled back a little bit, but came back up. And that I truly believe is all rate sensitivity. As people saw that 6%, it's like, a little breath of fresh air. Hey, 6%, I can go ahead and pull the trigger, but 6.75, 7%, I'm going to have to wait. Yep. That difference in the payment is just making, it's making a lot of people hesitant.
Well, and we talked about this a lot, is it's the uncertainty, right? Are rates going to go back down? Are they here? Where do they stay? When we saw rates kind of drop a little bit and then just sit there, people were okay that rates were higher than where they were a year ago, or higher than where they are 2 years. But when it's moving up and moving down and moving up, like people go, when it's on the way up, they go, okay, maybe it's going to go back down like it did 3 other times in the last 6 months. And that's where I feel like we get this like holdback of, not only are we losing buyers because rates are going up and they're being priced out, we're losing buyers because they're sitting on the sideline going, where are we going?
Yep. And you read the headlines and it's all over the place. It really is, and one of the people I've got to disagree with respectfully at this time is Barry Habib. Who's a very well-known person in our industry. I got to disagree with him. Yeah. He was right to a point with the pullback, the initial inflation rate of 8.2. Yeah, it's going to pull back. When that pulls back, our interest rate should fall. And he was right. But the problem is he was projecting continued decrease in the inflation rate. And we're not getting it. And until we get it, rates will not pull back. They can't pull back.
Yeah. And you look at what's happening here. We have you see inflation's not pulling back. We're seeing like the jobless claims report, just came out, and they're saying it was a small decrease. Like, okay, so less people are losing their job, and whether it's smoke and mirrors, I don't know, but all right, so less people are losing their jobs. We're still super strong, but we can't say for a fact that we know it's a lot harder to find a job right now if you're out of work. Like, that's definitely gotten harder, but it's hard to be like, hey, inflation's up, but employment is still at unemployment, it's at an all-time low still. Like, where's that balance? Like, you almost, sometimes it's like you need more people to lose their job to help taper some of this, but you don't want that for anybody. But you don't,
And the Fed's looking. Yeah, Fed's looking at that employment number and going, it's still too strong. It's still too strong.
And that's the hard part is the Fed's looking at all this data and they're saying it's still. So I think, like you said earlier in this, we're going to see, we're probably going to see 50 bips. I think we are. And they're saying possibly 3 more adjustments, increases this year from the Fed, which the hope when we did a quarter back, a month ago was like, we're finally seeing it slow down. Rates are going to go down. We're going to see it.
Here comes the pivot.
And that was squished really quick. That took all of like a day or two for Powell to say, hey guys, taper your expectations, which then drove rates up. On the mortgage side, we saw it go, and it's like, where are we at now? I think ultimately until we see, we want a soft landing, but the Fed's saying, hey, we want a soft landing, but we also want to see some turmoil, or we want some turbulence. Like, we want to land this softly, but we need to see some turbulence too.
Yep. There's gonna be pain. I mean, they flat out said, hey, we've got to have a little bit of pain, and able to pull back. Yeah. Quite honestly, though, the thing that is really helping sellers at this point maintain their values is right here.
Yeah.
And we say it every week, and we've said it every week for the past couple months. Inventory.
Yep.
Our inventory. We have just been on since November, we've been on a constant decrease in inventory. Every single week, we're dropping our inventory. And as long as that inventory continues to drop, the prices we're not going to see that decrease that other parts of the country have seen. Other parts of the country, their inventories jumped, a lot more than ours. And then, we're in a constant decrease. So we've got all these people coming in, and we don't have the inventory of homes for them. And it's the same thing even with rental properties. There's no rental properties for these people, and that's why we're continuing to see all these apartments being built. For us to see a push downward in home values, a real push, that inventory's got to shoot up. We've got to get 1,000, 1,500 home increase. But when you looked at the numbers, I saw a graph yesterday. 75% of homeowners have an interest rate of 3% or lower. 75%.
Yeah.
They're not moving. I don't care.
You gotta have something that has to happen. Yeah, you've got like growth, increase, job relocation, need more space. Like, you got to have a reason. You're losing those buyers that are just like, I want a new house. Like, hey, I'd like another bedroom, but I don't need one. Like, I like a home office, but I don't need one. Like, it's hard to be like, ooh, not only do I have to pay way more, I can sell my home for more, but I got to pay way more. And then I got to monthly pay way more because interest rates. So I'm going to lose my 2.75 or 2.25 or 2.35. Like, shoot, like bars right now, like you're bragging if you got a 3. Like,
and you're just going to see people sit. And one of the things you are seeing, though, is the increase in home equity lines of credit.
Yes.
Because people are doing exactly what you said. Yeah, I'd love that additional bedroom. Maybe I'm better off borrowing against the equity in my home. And doing it, just building on here. Or you know what? Yeah. Do I need a bigger house? Would I like a newer house? Yeah, but let me just do some renovations. Let me redo that bathroom. And I mean, all the contractors I'm talking to, they're still extremely busy, swamped. And a lot of it is this renovation type work that's going on for them.
Exactly.
So, I mean, it's just that is the golden parachute right now for sellers is the inventory. And I get questions, is it a good time to sell? And it's like, you know what? It actually still is. If you present your house right, it's clean, presentable, and priced correctly, it's going to sell. I just got a $1.5 million home in Steeplechase under contract in 6 days. 6 days.
Yep.
And we had multiple people.
Mm-hmm.
I was actually taken aback. Like, wow, well, this is wonderful. You know?
Yep.
Wasn't expecting it though, because when you look, you get up here and you look at the days on market, average days on market has jumped to 63 or 68, excuse me. You plan that as a realtor is okay. Average is 68. What can I do to make sure that we're below that average?
Yep.
So it's just, that right there is going to continue to help the sellers overall in the market. And we're just, just watch it every week, watch the numbers. I think we're going to see the sales numbers for March are going to drop. We're probably going to drop back down to 200, 250 with this interest rate spike.
Yep.
And this is where I think you and I, education-wise for our clients, we've got to go back into the, education of the rate buy down.
Yep.
Offer the differences. Do we do a permanent rate buy down? Do we do a 2-1 buy down? I really haven't gotten into the 3-2-1s. I'm not so confident in presenting those. 2-1, yeah. Permanent, yes, definitely.
Yeah. I mean, the 2-1 definitely. I think the 2-1 makes sense. I mean, we see the 3-2-1, like that's. Like I've seen one seller being willing to give a credit that big. But the 2-1 does make sense. I do like, a permanent buy down too. It's hard because I do think we're going to see that drop in rates. So and the one thing that I do like about the 2-1 buy down is simply the fact that they don't lose the money if they refinance because it's sitting in an escrow. So it's not like it's a hard loss of money. So it can go down to reduce their principal payoff, or it can, cover out of the closing costs. Like it's there, so if they've got $6,000 left in that escrow for the 2-1 buy down program because they refinanced in 9 months, that money is still being applied somewhere.
Yep. That's a huge benefit of it. So thank you for joining us. Those are our numbers for the week. Appreciate your time again, Joe, as always. Take care, everyone. We will see you next Thursday. Bye-bye.
Sounds good. Rock it.